Introduction. Welcome to our channel. Today, we're diving into a topic that's not only crucial for our planet but also for your investment portfolio: green finance, investing in sustainable and ethical funds. Hi, I'm Saving Sense 106, and in this video, we'll explore the concept of green finance, understand the importance of sustainable and ethical investing, and provide you with a comprehensive guide on how to get started. So, let's get started. Part 1: Understanding green finance. First, let's define what green finance actually means. Green finance refers to the financing of investments that provide environmental benefits in the broader context of environmentally sustainable development. This includes projects and initiatives aimed at energy efficiency, renewable energy, pollution prevention, biodiversity conservation, and climate change mitigation. Green finance can encompass a variety of financial instruments, including green bonds, green loans, and equity investments in environmentally friendly companies and technologies. It's about directing capital towards projects and companies that prioritize sustainability and environmental responsibility. To put it simply, green finance aims to support the transition to a low-carbon, more sustainable economy. It's about making sure that our financial resources are used to create a positive impact on the environment. Part 2: Why invest in sustainable and ethical funds? Now, you might be wondering, why should you invest in sustainable and ethical funds? There are several compelling reasons. Let's break them down. 1. Positive environmental impact. By investing in sustainable funds, you support companies and projects that are making a real difference in the fight against climate change and environmental degradation. Your money helps fund renewable energy projects, sustainable agriculture, and more. 2. Potential for strong returns. Sustainable and ethical funds have shown competitive returns compared to traditional investments. Many companies focused on sustainability are leaders in innovation and efficiency, which can translate into strong financial performance. 3. Risk mitigation. Companies that prioritize environmental, social, and governance (ESG) factors are often better managed and more resilient to risks, including regulatory changes and environmental impacts. 4. Aligning with personal values. Investing in sustainable and ethical funds allows you to align your investments with your personal values. You can feel good knowing that your money is contributing to a better world. Part 3: Types of sustainable and ethical funds. So, what types of sustainable and ethical funds are available? Let's explore a few key categories. 1. Green bonds. These are bonds specifically earmarked to be used for climate and environmental projects. They offer a fixed return like traditional bonds but are designated for green initiatives. 2. ESG funds. These funds invest in companies that score highly on environmental, social, and governance criteria. ESG funds consider how a company manages its environmental impact, how it treats its employees and communities, and the quality of its leadership and governance. 3. Socially responsible investment, SRI funds. SRI funds go beyond ESG criteria by actively excluding or including investments based on ethical guidelines. This could mean avoiding industries like tobacco or fossil fuels and focusing on companies that contribute positively to society. 4. Impact funds. These funds aim to generate a measurable, beneficial social or environmental impact alongside a financial return. They often focus on sectors like renewable energy, microfinance, or affordable housing. 5. Thematic funds. These funds invest in companies aligned with specific themes such as clean energy, water conservation, or sustainable agriculture. They allow investors to target particular areas of interest. Part 4: How to get started with sustainable investing. Ready to start investing in sustainable and ethical funds? Here's a step-by-step guide to help you get started. Step 1. Define your goals and values. Understand what you want to achieve with your investments. Are you looking for competitive returns, environmental impact, or both? Identify the values that matter most to you. Step 2. Do your research. Look into different funds and their performance. Review their ESG criteria, impact reports, and financial returns. Websites like Morningstar and MSCI provide ratings and information on sustainable funds. Step 3. Choose the right funds. Based on your research, select funds that align with your goals and values. Consider diversifying across different types of sustainable funds to balance risk and impact. Step 4. Consult a financial advisor. If you're unsure where to start or how to build a sustainable portfolio, consider consulting a financial advisor who specializes in ethical investing. Step 5. Monitor your investments. Regularly review the performance of your investments and their impact reports. Adjust your portfolio as needed to stay aligned with your goals and values. Part 5. Common myths about sustainable investing. There are several myths about sustainable investing that we need to address. Myth 1. Sustainable investments underperform. This isn't true. Many sustainable funds have matched or even outperformed traditional investments. Companies with strong ESG practices are often more innovative and resilient. Myth 2. It's only for environmentalists. Sustainable investing is for anyone who wants to see a positive change in the world while potentially earning competitive returns. It's about smart investing for a sustainable future. Myth 3. It's too complicated. While sustainable investing may seem complex, there are plenty of resources and financial advisors who can help you navigate the process. With the right guidance, it's just as straightforward as traditional investing. Part 6. Success stories in sustainable investing. Let's look at some success stories to see the real-world impact of sustainable investing. Success story 1. Tesla. Tesla's focus on electric vehicles and renewable energy solutions has not only revolutionized the auto industry but also delivered substantial returns for investors. Success story 2. Ørsted. This Danish energy company transformed from a fossil fuel-based utility to a global leader in offshore wind energy, providing significant returns while driving the transition to renewable energy. Success story 3. Beyond Meat. Beyond Meat has made waves in the food industry with its plant-based meat alternatives, appealing to health-conscious and environmentally aware consumers, and delivering impressive market performance. Part 7. The future of green finance. The future of green finance looks promising. As awareness of environmental issues grows, so does the demand for sustainable investments. Here are some trends to watch for. Trend 1. Increased regulation. Governments worldwide are introducing regulations to promote sustainable finance, such as the EU's Sustainable Finance Disclosure Regulation, SFDR, which aims to improve transparency in sustainable investments. Trend 2. Technological advancements. Innovations in technology, such as blockchain and AI, are making it easier to track and verify the impact of sustainable investments, ensuring greater accountability and transparency. Trend 3. Growing investor demand. Millennials and Gen Z are increasingly prioritizing sustainability in their investment decisions, driving the growth of green finance. This trend is likely to continue as these generations accumulate more wealth. Conclusion. Thank you for joining us on this journey into the world of green finance and sustainable investing. Remember, every investment you make has the potential to shape the future. By choosing sustainable and ethical